So we have arrived at the last section of the workshop. We're going to get into training and financial resources to support your donation or acquisition. So we're going to be welcoming up 4 panelists. First up, we're going to have Kevin Jackson. He's the Executive Director of the Chicago Rehab Network. Since 1996, Jackson's leadership has resulted in a number of initiatives and campaigns for affordable housing. Welcome, Kevin. And we have Jack Crane from CIC. He's manager at CIC, where he works with multifamily investors and manages a new single-family loan pool. Jack has specialized in inner-city investments for 30 years. Welcome, Jack. We also have Robin Coffey of Neighborhood Housing Services. She is Assistant Deputy Director at NHS and oversees all of their home ownership counseling activities, as well as their CDFI mortgage lending affiliate, Neighborhood Lending Services, Inc. Welcome, Robin. And lastly, we have Robert Rhodes, or Rob Rhodes. He's the Chief Operating Officer and the Executive Vice President of Programs for the Chicago Community Loan Fund. Throughout his career, Rob has been responsible for nearly $3.2 billion in capitalization across a wide range of portfolios. Welcome to you all.
Oh, sure.
Otherwise, it's
I think you gotta put it on slideshow first.
That's one. Oh, yeah.
Look at this one here. Good afternoon. Good afternoon. Nice to see all of you. Many faces are new, many faces are old. The title of this session is the training and financial resources to support your donation or acquisition. And I'm starting off with the focus on training, just to make sure it's clear, and the subsequent 3 presenters will be much more on the financial piece. At the Chicago Rehab Network, you see the mission up on the slide. It's historically written. We began in 1977, focused on community empowerment and development without displacement. You know, the reason we're so committed to this is in no small part is we've seen the gain of what happens when we work across communities and learn and share from each other. And we're also interested in the long-term stability of building the assets for families and also for the neighborhoods. Our members, to give you an introduction to our structure, is we're exclusively run by nonprofit developers and organizations. The Resurrection Project is here at one table. Wacona Reyes is my vice president. She was involved with some of the discussions around the land bank. So we have organizations across the city. Luch is here today. They're also very active in this space. Our work at the Rehab Network is not to touch real estate. That's what our members do. At the Rehab Network, our work is about the public policy that's needed to advance communities and the success of matching affordable housing as the conduit that builds people's opportunities in the lives of their neighborhoods and for their families. We also do a lot of work on the training and technical assistance front. We've been doing it for over 35 years, and one of the takeaways I'm going to talk about at the end is we are launching our 18th year of an empowerment series, which constitutes over 140 hours of learning. And that's one of the services that we work with, is the training and capacity building. Many people know us for the fact book that we just put out. And that's research based on the 2010 census and what's happened. What we know is we've seen incredible growth in housing insecurity. We all know that when we go out to the neighborhoods. Frequently, though, the broader public gets lost on what's really going on. In Chicago, according to the fact book, virtually every community has seen an increase in cost burden, and it's happened within every income group as well. One of the strongest ones, just to give you the severity and why we really need to marshal some greater attention and support to this issue, people who make between $50,000 and $75,000 in the city of Chicago, in the year 2000, about 18% of that population group, which represents over 200,000 families, about 18% were cost burden, paying more than 30%. 10 years later, over 50% of that population is now cost burden in the city. That's the housing insecurity that creates a lot of instability. So we work at how do you get the best practices put in place. And the reason we do that well is because we're being informed by people who are out in neighborhoods figuring this stuff out. And what do they need to do it better? That's our operation. You'll see up on the note, we do the Legacy 35 campaign. It's just looking at all the practices that and victories that have happened, and we're looking to raise $1 million so that we can expand our work. And we've always supported land bank. The takeaway in part is by sharing and recognizing we want to get rid of the blight. That's our common interest, whether you're a for-profit, not-for-profit. We want to get rid of the blight. That's a common value. We want to make sure there's not failure. And that's what the training capacity comes in. On slide 2, I'm just going to go through quickly some of the stuff that we'll talk about in our trainings in details, is you have to get through the factors. We heard some of this before, the zoning and regulatory environment, the location and neighborhood. And market area conditions will all weigh in. The next slide talks about the financial resources. There's different resources. And to give you an example of our training, we spend 2 days, 2 8-hour days going through sources of finance. And it's done by people who've done this work. Many of the people who do the training are actually the members of the Rehab Network. So they're coming from that experience base. In the pre-development space, you'll hear from Rob at the Chicago Community Loan Fund. They do that. CIC, Jack does that here. Jewish Council on Urban Affairs has a loan fund, money for pre-development. LIST, the Local Initiative Support Corporation, does. Cook County Department of Planning and Development has some, and so does IDA in terms of the Illinois Donation Tax Credit, which that represents, just to give you a sense of the scope of the Rehab Network. We don't touch property, but it was through our members and our allies that we passed that last decade, and it's been an incredible source. There's construction financing, and it just has a program, again, CIC, Jack Soin to my left, talk about that, and the loan fund. The state, we have to look at the IDA, the Illinois Housing Development, and then there's some banks that are working on this front. Bank of America has a 203K program, Urban Partnership Bank, and there's probably others. Other grants and home buyer subsidies, of course, many of you know the Federal Home Loan Bank, Neighborhood Housing Services, and the Illinois Clean Energy are sources. And now we just learned today at lunch that the Land Bank has its own source of funding as well, which was very good news. And I'm going to wrap up now with the training and technical assistance work that we do. I'm very proud of the work that's been happening at Rehab Network, and that would be preceded myself, because there are so many people across the sector, from government, nonprofits, and for-profits interested in community development that have gone through the Rehab Network trainings. We're going to invite all of you to join us in that pursuit. Several people in the room here have done that. In the Legacy campaign that we launched, we recognized 3 of our graduates. Lawrence Grisham, who's the Managing Director of Housing today. Chuy Garcia, who was here earlier, who's Commissioner of Cook County. And third one is Katrina Van Valkenburg, all got Legacy Awards because of their work. Katrina does the supportive housing space. So what we have in front of you then is, and outside are the postcards that you can take away that outlines the next empowerment series that is going to be starting in September. And then there is a flyer that talks about 2 specialized trainings that we've done in the past about successful development of vacant homes, project feasibility and analysis. And so it's a very hands-on, very detailed discussion. And this one is going to be 2 hours, either in the morning or in the afternoon. It's Monday, September 8th in the morning at 8, or Tuesday in the evening on September 9th at 6. You can see how to register for all of this on the flyers and cards supplied. You can always reach us at our work office, and of course we're online at www.chicagorehab.org. But we look forward to working with you and build the community that needs to really help people in Chicago succeed. And what, yours? There we go.
Well, good afternoon. I'm Jack Crane with CIC. We're Chicago's, well, actually it was, I'm going to talk specifically about a new fund that we have for 1 to 4 unit properties. A gentleman asked me just a few minutes ago, he said, well, I thought CIC just did multifamily, and that's what we're known for, doing acquisition and rehab financing throughout Chicagoland for highly distressed multifamily properties, 6 units or more. But the good news is that through the Preservation Compact, which is an affiliate of ours housed at CIC, we addressed this whole issue of thousands of single-family properties that are now vacant and distressed, and how can CIC be a part of turning those properties around. As many of you know, 50% Cook County's rental properties are in the 1 to 4 unit property criteria. So there are a lot of single-family homes throughout the county that are rental. So one of the issues that we found, one of the biggest need that we found in talking to investors who are buying these properties is that they could come up with the resources to acquire these funds, rehab the funds, but there was no takeout fund. In other words, they could use their own resources. That might be investors, banks, hard money lenders, etc., to acquire and rehab, but then there was no takeout to recapitalize the investors so that they could buy more properties. So we put together a 20. This is working. Yeah. Can't see. There we go. Okay. That's a $26 million pool, and we want to thank them very much. Part of this fund is there's some unique parts to it. One is that there needs to be a minimum of 9 units total to participate in this fund. In other words, 9 single-family homes, 3 flats, some combination of 9 or more before you're eligible for this financing. Another criteria that's unique to this fund is that the 9 units, the majority of those 9 units need to be in the same neighborhood because we're looking to have impact in a localized way. In other words, 9 units in Englewood or 9 units. That's the other criteria which is unique to this fund. We've had a number of investors over since we opened the fund this year. They may have 3 units in Austin, 3 units in Uptown, and 3 units in Bronzeville. That does not qualify. So you need to have that concentration as part of the package. This is the basic criteria, underwriting criteria, basic terms, I should say, for the fund. It's a 10-year fund, 10-year term, 15-year amortization. loan to value of 120%, and I'm going to get back to that. Loan to cost of 80%. Debt coverage minimum of 1.25. We'll have a first. There's no prepayment penalty. So if you want to get attractive financing down the road, it's okay to pay us off, and it's a full recourse loan. And as I was listening to Brian and Russ this morning, I was thinking about how can this fund connect with what they were saying. And part of it is, as an investor, let's say Brian gives you a property, enables you to get a property for zero. Property zero, it's yours, you own it. It costs you now $70,000 to rehab it, and that's all terrific. You're given the property, so the investor goes, wow, this is fantastic. It now costs you $70,000 to rehab it, but here's the bad news. The appraisal is only $47,000. So that's really the issue that our fund is addressing, and that's the issue. That's the reason why it's ending up in the land bank, is that private investors are not attracted to buying these properties because the market value is not there, as we know. I could get into that more, but I won't. But the good news about our fund is that we will actually lend 120% of value. In other words, in this particular scenario I was throwing out, it costs $70,000. We will lend $56,000. Let's say it costs $70,000, the value is $47,000. We will lend up to $56,000 on that property because that's 80% of the cost. So the investor would have to come up with $14,000. That's very unique. You're not going to be able to go to your local bank and get that kind of financing. And that's the way that we're trying to stimulate and stabilize some of these neighborhoods. So what you would have to do to get to our fund, of course, is do 9 of these, or 3 properties with 3 units. And as long as the debt coverage, and that really is our primary underwriting criteria, as long as the debt coverage is 1.25, in other words, the income is 25% higher than the debt service, you'll be fine. And it will qualify for our fund. I think we were getting a lot of calls because we're known as providing acquisition and rehab funds. We don't do this on this fund. The very good news is my friend Rob Rose at the end here at CCLF will do that. So we have a lot of partnerships. We have a partnership with CCLF whereby they will provide the aggressive acquisition and rehab funds, and Rob will talk about that. And then once you accumulate 9 units, you can walk over to our shop and we will refi Rob's loan, and then you can continue to use CCLF's funds to buy more properties. Because that's part of what we're trying to do, is to create a pool of investors, responsible investors, good investors, who are going to take these distressed properties, do a good job rehabbing them, and be responsible managers. So not only will CCLF, but there's also banks. That's the other part I just want to note, is that a lot of banks, some community banks, will do the lending on the acquisition and rehab, knowing you can come to our fund to pay off their loan. A lot of banks, community banks especially, are interested in the short-term loans, 6 months, 1 year. They will give you a line of credit secured by this property. They'll especially give it to you if they know there's a takeout. So part of what we're doing for investors is you can sit down with us and we can sort of what I would call pre-qualify you. We're not going to give a letter that you're pre-qualified, but we can talk to your bank or your investors and say, yes, based on this criteria, we would take out the loan. So that's the basic program. I think we're up.
So Our loans are aimed at owner occupants. So these are people who want to acquire the properties to actually live in them and make them their principal dwelling. And we make loans to homeowners. They're for this purpose here, purchase rehab loans, so we include the rehab costs. We have a 3% down payment. Again, no private mortgage insurance. One of the things that makes us unique over a bank is that we're completely fine with taking deed restrictions and covenants that are usually behind us. So in other words, we have no limit on the combined loan to value, especially when it's soft debt in a subordinate lien position. We have down payment assistance that's available, but the amounts and terms of that are subject to the various funders who give us this money and their restrictions. When we say rehab loans, we also have a staff that goes out, inspects the property, works with the homeowner to develop the scope of work. As we primarily are making sure that code violations, the housing is brought up to a housing quality standards, essentially livable, but obviously a homeowner also has other things they want to do. So we do help provide the scope of work, writing up the specifications, working to make sure that there's multiple bidders for that, and then working with the homeowner so that they can select a contractor. And then once the loan closes, working again with the homeowner and the contractor as we go through the construction process. Our capital comes from two primary sources. We have $34.5 million from 19 community banks, which includes our sponsor here today, the private bank. We also have funds now from JP Morgan Chase, which helps to provide some of the loss reserves that we're using for the $34.5 million. And it also lets us do some unsecured home improvement lending in some of the same communities where we're doing these loans or where the land bank is active. And that's primarily to help those homeowners who need to do improvements to the property, but essentially because of the value collapse, have no equity in the property. So our resources are targeted. Again, most of it is in the city of Chicago. In the south suburbs, we're looking at Thornton Township, which is a mildly distressed township in the south suburbs. And then we also deal in Kane County. We provide home buyer education, 8 hours of home buyer education, and then a 1 hour one-on-one. The intent of trying to build up a home buyer pipeline, and again, including talking to our home buyers about properties that they can acquire either through the land trust or through other entities, and not making them afraid of taking on a vacant property. And I think that's going to be it for me. Turn over to Rob, my other Chase cluster guy.
Good afternoon. So, again, I'm Robert Rose with the Chicago Community Loan Fund, and we are a CDFI loan fund established in 1991, really to help fill financing gaps as they exist. So what do I mean? As we talk about the products that we offer here, Jeff talked to you about some of the limitations that CIC is having on their pool. So if you're looking to finance these properties, we are able to provide the acquisition and rehab financing, as well as offer the in-loan or takeout financing for properties that do not meet the 9 property criteria. So the whole idea is that we as a fund, in our history and in particular with this program, are helping to fill the gaps such that together we offer a full comprehensive approach to financing in this space. So our priorities in terms of CCLF, we tend to work with smaller groups, and we're comfortable with that. We tend to work with grassroots groups, smaller developers, nonprofit organizations, faith-based organizations, all of which the size of the group doesn't concern us so much. We do want groups that, one, have knowledge and passionate about the areas in which they're working, and two, have an interest in growing their capacity. We have a number of groups that we work with one property, and from that one property, we've been able to build them up to 5 and 6 properties, through the course of working with them. So if you're a new group, I get this all the time, what if I'm a new group? A new group by itself, we wouldn't work with, right? Just brand new out the gate. But what we say to new groups is, new groups, find someone with experience who will sponsor you, who will guarantee your loan, who will form a joint venture with you. You have the passion for working in an area, but we do need you to have someone who has some experience to work with, because part of the bubble and part of the issue that got us here was a lot of inexperienced people jumping into real estate space, chasing returns, chasing flipping premiums, and if we're going to get ourselves and stabilize these communities, we need people who have a good working knowledge and understanding of how to properly rehab properties, properly find renters if they're going to rent, knowing how to source potential home buyers if they're going to sell. And we're interested in working with people who can identify those groups that have that knowledge they can work with. So if you're a new group, be creative about who you partner with, bring that partnership to us, and we can certainly make it our best efforts to work with these groups. So how will we support the land bank? I'll talk about how we'll support the land bank, and then I'll talk specifically about our product in the next couple of slides. So in a couple of ways, right? So primarily, we are looking to support it with our 1 to 4 unit product, and I'll be talking about that in the next couple of slides. Being able to help groups acquire and rehab those properties, helping them to aggregate those portfolios either for a CIC takeout or for some other bank takeout. Some people have banking relationships, but they need to have a certain threshold before those banks will be interested in doing those property acquisitions. Our product can help with that. The other part of it is that we have a very strong referral network with developers, with rehabbers, with government and nonprofit organizations, and tapping you into that, whether it's us helping you think through your strategy, us helping you connect with a unit of government or with a organization. Part of what we really bring to the table are those relationships and the willingness to help broker those relationships such that you can have a successful project. Okay. Okay. Thanks. So our project is available for 1 to 4 units. As we talked about before, you've probably heard many times, this asset class has a difficult time attracting capital, especially for the investors. Right? So we are making this product available, in which we are able to offer loan funds for projects that are in low to moderate income communities, as defined on the screen here. 80% or below AMI census tracts from a place-based qualification is necessary for our funds. We lend in Cook County and the Collier County, so 6 counties, Chicagoland region, by which we can operate. So for those who aren't in Cook County, Kane County is here today, Will County, DuPage, we're able to also extend this product to you. In particular, we're also working in partnership with CIC and NHS in collaboration through our work with the MMRP, the Micro Market Recovery Program, in addition to supporting larger, broader community development efforts across the. Alrighty. And then the loan parameters. So what does it take, right? What we're looking at is typically a 5 to 7 year term, up to a 30-year amortization. Interest rates during the rehab period, interest only 8%. Permanent loan is going to be fixed at 6.5%. We're looking at 2% origination fee, a $250 application fee coming to us, and we're looking for groups that have some experience. 2 years is a minimum threshold that we look for in terms of demonstration of experience, but that's a combination of groups you bring. So you have a new group, and you're able to find a group that has that experience. We bridge all that experience in terms of the organization that's coming to us looking for a loan.
Want to make sure there's anything else.
Okay, yes, so loan to value, we have a sliding scale. Loan to value can go up to 120% loan to value, and 90% loan to cost. So much like we talked about before, there is in many communities a gap between the appraised values and the cost to rehab those properties. And so what we're able to do is to help bridge a lot of that gap by going up to 120% loan to value. So in Jack's example, we talked about $70,000 rehab. You got it for zero, $70,000 cost to rehab. It appraises for $47,000. Able to lend up to $56,400 for rehab funds against that $70,000. So it doesn't always make up the gap because in this case we're capped at 120% loan to value. Available for rehab that you wouldn't have access to in any other situation, and certainly our rates are going to be much more favorable than hard money lenders. And if you're looking for investors out there, they're typically going to want anywhere from a 15 to 20% return on their money. So again, we think we have a compelling product to offer. It works in concert with what we talked about. Our goal isn't to compete with anyone. It really is to help fill that gap. So we have customers that are CIC customers that want to use our product to aggregate to the 9 units. That works out perfectly fine for us. Our product acquire, rehab, and sell the property. You can do that as well. Take out, once you take out our construction funds, you can do the property as you need. 2 caveats to that. One, we want to make sure the house is being sold at an affordable level, right? Our back of the envelope calculation means that these houses are sold for a price of $250,000 or less, okay? 2, we want to make sure that you have a demonstration of being able to sell these properties. So this is having some working agreement with a broker or realtor company that knows how to pre-qualify and sell. This is working with NHS or a number of other groups that offer that financing, working or having an arrangement with your banking institutions. But we do want to make sure and understand that you have the capacity to find responsible home buyers and to be able to sell the properties. And then we can also support a purchase, rehab, and sale strategy. That's it for me, I think. So that's live.
Yes, you open for questions.
So, yeah, questions, I'm sorry. There's one.
Mr. Crane, on your program, does it have to be 1 to 4 units, multiple units that add up to 9, or can it be one property that has 12 units?
The fund I talked about, it has to be 1 to 4 units that adds up to 9. But if you have a 9-unit property, we have terrific programs for that. So.
I have a question. Your loan with CIC, are you able to hear me?
Yes.
Yeah, your loan with CIC is full recourse, as I understand it.
Correct.
Now, there's many people in this room who would like to do deals with CIC. Recourse may be an inordinate burden upon whoever would like to do the deal, who does have a track record, because they may say, well, I can go to my bank, and maybe it's the top 10%, top 20% that there's recourse. But your loan is full recourse. Don't you have some other way of doing a loan and feel comfortable with it, with some other type of recourse, or partial recourse?
That's a good question. I'd be very surprised. I'd be delighted if banks, but your local bank was only taking a 10, 20, 30% recourse. That would be very unique. I think the full recourse, we've done full recourse lending for 30+ years. So it is an issue. Frankly, one of the other issues that we've seen especially with the smaller, medium-sized investors is that a lot of the good investors failed 5-6 years ago, so their credit is not very good. And I want to say that because we're a mission-driven institution, we will take a hard look at that, because I think a lot of good investors want to get back into the real estate development business, and we are not going to be looking at your credit score so much as we're going to be looking at your track record and why you failed. There's a lot of good reasons why people failed during the deep recession. So I just wanted to add that it's sort of another side of the whole credit question.
And I like that. Add to that too as well around the question of recourse. Part of our loans are also full recourse, and the logic behind that is we want to make sure that we're doing responsible lending, and to the extent that a person doesn't feel comfortable with having full recourse in the loans they're getting, tells us something about, or it serves as an additional hurdle in terms of how much more debt they want to take on. So while it's very common for larger scale properties to do partial recourses and release of recourses, what we're talking about, for the loans that I'm talking about, average size is $100,000 loan. If you're unable to do full recourse $100,000 loan, I probably will not be able to make the loan at all. Because I think that's a reasonable expectation for the dollar amount and for the type of lending, that's being done. So these are smaller groups that I'm dealing with, but even with 9 properties, you're talking about a loan that probably won't exceed $1.5 million. Full recourse, I think, is more than warranted for this type of lending.
Mr. Creighton, I'd like to respond to your answer because it seemed like in your answer, you left some opening for non-full recourse according to that answer. Let's use a hypothetical. Person has a clean record, never went into default, never went through a foreclosure. I'm just saying the people in this room have never gone through that particular situation. You left an opening here that said, in my mind, maybe there's a reason why we don't need full recourse. Could you explain that, please?
Well, first of all, my hands are tied on the recourse issue. This is a fund that we manage, so all of the banks that are participants in that, this was the criteria that they required to cut the check, for $26 million. So we really have no choice. We cannot be flexible on the recourse side. The place where we can be, I won't say flexible, I would say thoughtful is on the credit underwriting side. That we recognize the issue of why people get into trouble. Good developers get into trouble, and we want to welcome them back because we want their talent and experience.
Just another comment, and I don't mean to monopolize this. If this loan were made with Illinois Housing Development Authority, there is no recourse but for fraud and waste. And that's all the recourse there is. You're talking about millions of dollars of loans. You're talking about a significant amount of money relationship to the deal. Is that at all a possibility if IDA is willing to go that far against the governmental program, all that? But the IDA is willing, and it's not governmental in the sense that it's the government that's sponsoring this, but it's tax credits that the government offers if you do these particular deals. So is there a possibility within the framework that you do at CIC that it could more mimic the IDA program?
Yeah, I think that's a great question. This our fund here, it's a pilot program. And if we see the kind of demand out there for this fund, it's a 3-year program. I think we could attract IDA and maybe other sources for non-recourse financing. I think you're correct that if we had a non-recourse fund, we would attract more investors, and that's what we want. So through the Preservation Compact, which is our public policy arm, we would definitely want to look at that. On the multifamily side, our clients do that all the time. They do the recourse lending with us. We do the acquisition and rehab funds. They stay with us for a few years, and then they'll refi it with non-recourse Fannie Mae, Freddie Mac, and that's terrific. That's a great program. On the single family, this is a new product, so I think if we see that kind of demand, that's when we can go to IDA and say, you know, this has been successful. We've done 500 homes. We could do 3,000 homes if we had non-recourse.
Yeah, and the issue of recourse, right, has to do with your source of funds and your financial strength. I mean, IDA, Fannie Mae, Freddie Mac are able to absorb the losses that frankly would kill my fund. So the other part of it is not to be a hard ass about it, but it really is to protect the assets of the organization. If you think that we have a worthwhile mission, we want to be around for the next generation. Part of what we have to do is protect that with recourse funding.